Up almost 75 points, so 18,276.
Today, the Indian markets are pretty much flat. The Nifty Bank went to those all-time high levels in early morning trade, but since then, it slipped a bit from the top of the trading session.
For the markets, we have the Bank Nifty, which is outperforming with gains of 0.3%. Mid-cap side of things, however, are not looking so good.
In the last 1 hour, there's been significant buying coming through in the Nifty banking index as it powers away to about a 0.5% up move.
70 points lower is what the Nifty is going to go home with. Banks end higher. The Nifty Bank, PSU banks, of course, outsized performance once again.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track the 6 hours of the day's trading action in just 5 top headlines. I'm Nigel D'Souza. Let's get straight to the top stories for the day. Profit booking on the Lal Street as the Nifty drops 1% from the high point of the day. Bank stocks buck the trend with the Nifty Bank making record highs and closing at record highs. Hindalco slips after its arm Novelis guides for a pullback in profitability due to high cost. But Coal India perks up on a hefty dividend despite an earnings miss. MRF slides on sharply lower margins. Dr. Lal's as well as Metropolis slips on fears of rising competition, while Jubilant Food sulks as the non-pizza business disappoints. The PI Industries rallies as the new brands kick up growth. Tata Motors misses estimates in the second quarter, reports a higher than expected net loss of around 940 crores on the back of treasury losses as well as sluggish recovery by JLR. Margins also miss estimates but fare better than a year ago. The rupee gains ground against the dollar, hitting its highest levels in 5 weeks. Dollar weakness and higher FPI inflows aid the rupee. Well, here's how the day panned out. Profit booking on the Lal Street saw the sensex and the Nifty drop close to around 1% from the high point of the day by the time we wound up. The Nifty, did drop close to around 50 points. The sensex dropped around 150 points at the closing bell. Well, banking stocks, they bucked the trend. The Nifty Bank made a record high and, in fact, ended at a record closing high as well. Prashant Nair is with us to run us through all the market action. Prashant?
Finally, by close, neither here nor there, at least on the index, the Nifty, what was peculiar was that the move did come in the last hour of trade, exactly starting 2:30, like what we saw on Monday and on Friday the week before. But the direction was different. The direction was on the way down, and that did not change. The Bank Nifty was much better. It ended higher, but it also made a new all-time high right at the word go, right at open, but then came and spent the bulk of the rest of the session flattish, trending sideways. Nifty gains, largely old economy names did very well. Adani Ports, Coal India, ITC, a few names. The cuts coming through in names like Hindalco, Power Grid, Divi's Laboratories, and Tech Mahindra. By the way, market advances to declines ratio was almost 1:1. So that kind of told you what happened in the broader market. And like what we've seen for almost a fortnight now, the big outsized stock moves in mid-caps, etc., were all earnings related. So look at, names like PI Industries and Bosch, which reacted very positively to earnings and earnings disappointments. Lal Pathlab sold off very aggressively. Metropolis, Jubilant Foods got smashed. MRF. There was Hindalco, which reacted to the Novelis numbers. Godrej Properties came out numbers in the last 2 hours of trade. And Ramco, Interglobe, did not react to numbers on Monday. Numbers actually came out last week on Friday, but sold off today. PSU banks is a constant theme, which is continuing to do well. PNB, Bob, Union Bank are a few stocks that I wanted to highlight. Just one thing, and maybe it's wrong to make a sweeping remark and we'll put the numbers together, but as we come to the fag end of the earnings season, there seems to be more earnings disappointments as compared to upgrades. So that bears watching. From a global arena, 2 things. Dollar has been falling 3 days in a row. It's an important level. We, emerging markets, generally want the dollar lower. The direction seems to point south, but we'll see what happens. Results of the US midterm elections are important, but I think the bigger cue out of the US really is the inflation number, which we will get later on Thursday. Back to you.
Thanks a lot for that, Prashant. Well, in market opinion, Krishna Kumar Karva, Managing Director of MK Global, sees worries from high valuation and near-term earnings hiccups. He sees massive tailwinds in the banking sector, advises investors to stay put. Let's hear him out.
Optimism is very strong, and we are almost as an index level, we are almost near the 52-week high. And this is obviously a function of robust corporate performance and robust government policies, which augurs well for the coming 3-5 years also. Now, trying to time the market is very, very difficult. We have seen that despite $22 billion worth of selling by FPIs over the last 11-12 months, our indices are back to its peak. In June, we were something like 15,000 odd, 15,500. From there, we have recovered. So I would imagine that it's better that investors focus on bottoms-up investing and stay invested from a medium-term perspective. Banking continues to remain robust, and from a next 2-year perspective, investors should at least get 15 to 20% compounded returns. But I think within that, if you look at your large private banks, if on a 1-year basis also have delivered almost like 15% returns. But it's the public sector banks which have delivered stellar returns of, say, almost 30 to 40%. And going forward also, whenever a sector is in tailwind, it is the tier 2, tier 3 participants who possibly will give superior returns. So aggressive investors should look to be investing in public sector banks or even tier 2, tier 3 private banks, where possibly the returns could be much more stellar.
Well, in more market opinion, global investors could come to India if they're looking for alternatives. That's the word that's coming in from Mark Matthews of Bank Julius Baer and Company. He also adds that with the long-term view, they would still remain invested in India. Let's hear him out.
The global investors, they, I think, who are not in India presently, could come in if they're looking for alternatives. And it looks like, real old-fashioned economy stocks, industrials, financials, things like that, they've clearly begun to outperform technology. And that would lead you to India. On balance, I'm still perfectly fine with India. I think over the next 12 months, it might underperform the North Asian countries because they did so badly last year. But if we take a longer-term view, we'd still like to be in India because of the strong demographics and all those things that I'm sure you're well aware of.
Well, to the second headline now. Hindalco fell closer around 5% after its arm Novelis reported an inline set of numbers. The problem is they guided for profitability, taking a knock going ahead. Well, let's tell you about the Hindalco, the Novelis's numbers then. If you look at the absolute EBITDA, the deliveries or even the EBITDA per ton, well, it was in line with what the street was working with. That's for the past quarter. However, because costs have been rising, well, they softened their stance with regard to the near-term guidance. That meant that they guided that maybe the EBITDA per ton could get pulled back by around $75 to around $100 on a per ton basis. That would bring the EBITDA per ton down to say around $420 to around $440 per ton. And that's what they have recently delivered. The last recorded number is around $514 per ton. So because of the soft outlook, the street took that as a bit of a disappointment. Though in the longer term trajectory, they say that they continue to stick to that $525 per ton. In other details, they also said that the capex, they're pulling back a little bit. Remember, earlier they were guiding for around 1.3 to 1.6 with a guidance to the lower end. Now they've pulled that back to around 900 to around $1 billion odd. Let's get some of those graphic plates up for you. And also the debt number, well, it increased a little bit on a sequential basis. Though they say that then in the second half of the year, the working capital that has got built up, well, that'll get released. So that's to the tune of close to around $600 million odd, which will help them, in terms of the free cash flows as well. So we'll keep an eye out for that because they're guiding for $500 million of free cash flows for the year. That would mean a big turnaround from what they did in the first half of the year. Moving to Coal India, that gained close to around 3% on the back of the hefty dividend, despite missing estimates in the second quarter. The numbers up for you on the screen, the top line, the EBITDA, as well as the profitability, all of them missed estimates. Now, on the top line, the reason for the miss was realizations were a little bit lower, and we're just comparing the blended realization that they gave with Kotak's estimates. And that missed estimates were close to around $90 per ton. The key reason for the blended estimates, blended realizations missing estimates, was e-auction volumes are much lower than what was anticipated. So it came at around 10-11 million tons, or that would mean that in percentage terms, it contributed less than 7% of the total sales volumes. Remember, e-auction, well, that's bulk of their profitability and higher realizations as well. So with that contributing less, it took a hit on the realization front. On the cost front as well, employee costs were higher, The stripping activity, that's basically a non-cash expenditure that was higher, but that gives visibility for good production going ahead. What surprised the street positively, though, was the dividend payout of close to around 15 rupees per share. The street liked that, and that explains why the stock did well in today's trading session, ended high with a gain of close to around 3%. Well, that's about Hindalco as well as Coal India. But moving to the third headline today, MRF was down close to 8% after it failed to deliver in the second quarter, while CEAT gained close to 5.5% after it reported an improvement in margins. Sonia is with us to run us through the results of both these two tyre companies. Sonia?
Well, thanks a lot for that. So, just to start off, let me tell you that there's no problems with the top line. So, the revenue growth for MRF has been pretty solid this time. It's an 18% growth year on year. CEAT too has done well, and that's because of the pickup that we've seen in the OEM space. However, the problem really for MRF is in the margins, and it's very peculiar. CEAT is up 5% while MRF is down about 5 to 6% because CEAT has reported an improvement in margins quarter on quarter while MRF has seen a fall. So if you look at it, CEAT's gross margins have improved quarter on quarter to 32.5% compared to 31.7% last quarter, while the EBITDA margins have improved quarter on quarter to 7% versus 6.1% last quarter. In fact, for CEAT, for the last preceding 2 quarters, it was languishing between 6 to 6.5%, and there has been an improvement to 7% this time around. But that's not the case for MRF. MRF's EBITDA margins are down 30 basis points quarter on quarter and 230 basis points year on year, coming in at a multi-quarter low of 8.2% versus 10.5%. Now, if you look at an average, right, MRF has been in this 10 to 11% range for a while, but this time around it has slipped. So what are the reasons? It's difficult to gauge because for MRF, the management really doesn't come out and tell us what the model mix is and why their margins are under pressure. But for CEAT, the gross margins have improved because of the price hikes that CEAT undertook in Q2, and the price hikes that CEAT took was then followed by competition. So the assumption is that CEAT went ahead and passed on all the price hikes to consumers, while other players like MRF couldn't do that to the best of the requirement, and hence this diversion in margin performance. Back to you.
Okay, all right. Well, the divergent moves on both those two tyre makers. Thanks for that, Sonia. Moving on to Jubilant Foodworks. Well, the stock was down close to 6 to 7% despite reporting inline set of revenues as well as EBITDA for the second quarter. However, the company missed estimates on the profit front. Mangalam joins us to run us through the key highlights and what went wrong with these set of numbers. Mangalam?
Well, as far as this quarter's numbers are concerned, they were largely in line. However, the street is looking at what took place over the last 3 years and what is likely to take place over the next 1 year, and perhaps as a result of which we are seeing that cut on the stock price in today's trading session. As far as the second quarter is concerned, the revenues at around 1285 crores, largely in line with the street expectations. Also, the net profit, EBITDA at 312 crores, and it was expected that the margins will contract because we have seen inflation in both cheese as well as vegetable prices, and going forward, wheat prices are also on the boil. The net profit, however, was impacted by higher depreciation, which is a non-cash expense, and higher effective tax rate as well. The Domino's like-for-like growth this time around has been 8.4%, and this compares with street expectations of 6 to 8%. And they've added 76 new stores this quarter. Again, here the street was working with a number of around 50 to 60 odd stores, and the management has guided for 250 stores to be added in this year itself. However, it's the non-Domino's business which has the street worried, because while they're looking to open 20 to 30 new Popeye restaurants in the country, the other verticals that they had generated, the kinds of Hong's Kitchen as well as Ekdam Biryani, they have put that on a bit of a pause mode. They're looking at the unit economics before taking a fresh call on expansion out there, and that is where brokerages are worried about. If you take a look at it over the last 3 years, ICICI Securities says that the revenues per store have actually been stagnant, and at the same time, execution in the new brands has utilized management bandwidth with subpar outcome. While they remain constructive on the stock, they've trimmed their target price from 750 to 720 rupees. Jeffries as well says over the last 3 years, the revenue CAGR has been a moderate 9%, and the entire benefit of price hikes that the company has taken has not flown through, primarily because consumers are now down trading. As a result of which, they too have trimmed their EPS estimates by 3 to 4%, but they remain holders on the stock with the target price unchanged at 580 rupees.
Okay, all right. Thanks for that, Mangalam. Well, moving on to Dr. Lal Pathlabs as well as Metropolis. Both of them were down 5 to around 8% after their second quarter numbers, as well as the fears that competition is on the rise from online aggregators, hospitals as well as pharma companies. Ekta is with us to run us through all of those details. Ekta?
Well, yes, it was largely an operationally in-line quarter, you'd have to say, for Dr. Lal's as well as Metropolis, where the margins improved on a Q-on-Q basis, and there was double-digit growth which came through for their non-COVID-19 business, which is basically their base business. But what the street is probably fearing is competition going forward. Remember, we've seen competition from the likes of online aggregators, hospitals, pharma companies enter, and that has resulted in price erosion, which the companies have alluded to in key routine tests as well as wellness packages. Now, brokerages are cautious. They expect key metrics to come off. For example, patient volumes are estimated at around 6 to 8% on a 5-year CAGR, as compared to around 12 to 14% that we've seen historically for these companies. Similarly, EPS is likely to reduce to around 2 to 3% growth CAGR in the next 3 odd years, as compared to an over 10% growth that we've seen historically, with margins not being able to sustain at those peak levels or return to those peak levels of 28-30%, simply because of the kind of competition that we might see in the space. Valuations are quite high for Dr. Lal's as well as Metropolis, 60 times or 55 to 60 times on a 1-year forward basis for Dr. Lal's, and around 40 times plus for Metropolis, and hence valuations are expected to come off for these companies going forward as well. Lastly, what could be growth drivers? Preventive testing, specialized testing, entering into new geographies, as well as possible further M&A is something that the street would watch out for in terms of triggers.
Okay, moving to Godrej Properties, that was down close to 7% after the company reported a weak operational update for the second quarter. Sonal Bhutra is with us to run us through all of those details. Sonal?
Thanks a lot for that. Well, yes, it was a weak operational update coming in from Godrej Properties. Bookings declined both on a quarter-on-quarter and on a YOY basis. Volumes too were down 25% on a YOY basis, down 4% sequentially. Bookings were down 6% on a YOY basis, down 4% sequentially. But customer collections on the other side, they looked really good. So they went up by 39% on a YOY basis, and they were up 24% on a sequential basis as well. So that is a positive takeaway from the results this time around. In the first half, they've sold area around 5.5 million square feet, which is up 26%. Booking value has gone up by 60%, and collections have gone up by 44%. Now, if we look at the geographical breakup, this weakness has come in from the Mumbai market because of a high base. So quarter-on-quarter basis, Mumbai bookings have halved. They had 2 big launches in the quarter gone by, and that's why this decline. MMR region saw 565 crore rupees in terms of bookings. NCR at 852 crore rupees, which has increased. Pune and Bengaluru also saw an increase in terms of YOY bookings as well. Debt in the books of the company has increased. Absolute debt at 1365 crore rupees, which compares with 956 crore rupees on a quarter-on-quarter basis. However, the management maintains their FY23 bookings guidance at 10,000 crore rupees. They do have projects lined up in this year itself, and that is something they expect will aid earnings in the second half. But on the back of these numbers, today the stock is not doing so well.
Well, Sonal, stay with us. On the flip side, your PI industry as well, the large size stock went up close to 10% on the back of the second quarter numbers. Take us through the key highlights in that one.
Well, yes, strong set of numbers. It has beaten all parameters, and it has come in on a high base, and that's why the excitement in the stock today. Revenue growth of 31%, EBITDA growth of 49%. Margins on the back of this have expanded 200 basis points to come in at 24%, and profits have also grown by 46% on a YOY basis. It was led by both the export market and the domestic market for the company. Export markets grew 29% on a high base, where volume growth came in at 25%, so there was a 4% pricing growth, 36% growth in the domestic markets, and volume growth came in at 31%. Newly launched brands by the company are something that aided to overall growth this time around. The management says that trend of rising input costs continued, and passing on these costs to the customers also continued in the first half. EBITDA margins improved because of a better product mix and also operating leverage. They continue to hold cash in their books close to 2,300 crore rupees, and they continue to look for opportunities as well in the inorganic arena, and that is something they continue to look out for. But overall, good set of numbers, and that is something that the street is liking today.
Indeed, the street loved those set of numbers. Sonal, thanks for joining in and filling us in with that quick update. For the time being, slip in a short break. We'll be back in a jiffy with the other headlines.